Hey, real estate investors, imagine this. You've just sold a rental property you've owned for years. Maybe it's a little duplex you bought for $200,000, and today it sells for $600,000. You're excited. You've made $400,000 in profit. You start picturing what you'll do with the money. Reinvest in a bigger property, pay down debt, maybe even take a long vacation. But then reality hits. You get the call from your accountant and learn that nearly half of that profit isn't yours at all. It's going straight to the IRS. Here's the truth most investors don't realize. The tax code isn't neutral. It rewards those who plan and punishes those who don't. And starting in 2026, that punishment is about to get a whole lot worse. That's why in today's video, we're going to explore the looming capital gains trap in 2026, why it matters to every real estate investor, and most importantly, how you can protect your profits with strategies like 1031 exchanges, installment sales, trusts, and even opportunity zones. So let's dive in. First, let's break down why capital gains are such a silent killer. When you sell real estate at a profit, you pay long-term capital gains tax. That's separate from your regular income tax. Depending on your bracket, that rate can be anywhere from 15% to 20%. But here's where many investors get blindsided. Depreciation recapture. Every year you've owned your property, you've been deducting depreciation to lower your taxable income. When you sell, the IRS wants a portion of that back, and the recapture rate is up to 25%. So let's go back to that $400,000 gain. Not only are you paying capital gains tax, you're also paying recapture tax on all the depreciation you've claimed. That can easily eat up $100,000 or more of your profit before you even see it. That's not just a tax bill, that's a financial earthquake. Moving forward, let's talk about why 2026 is such a big deal. The Tax Cuts and Jobs Act of 2017 lowered rates and gave investors more breathing room. But those provisions weren't permanent. They're scheduled to sunset at the end of 2025. If Congress does nothing, we go back to the old rules. That means higher income tax brackets, lower exemptions, and potentially harsher treatment of capital gains. For real estate investors, that's devastating. Imagine selling a property in 2026 and suddenly owing tens of thousands more than if you had sold in 2025. The same deal, the same profit, but a totally different outcome. That's why planning is non-negotiable. So what can you do about it? Let's start with the most famous strategy, the 1031 exchange. Here's how it works. Instead of selling your property and pocketing the cash, you roll your proceeds into another property of equal or greater value. By doing this, you defer both the capital gains tax and depreciation recapture. The key word here is defer. You don't eliminate the tax, you postpone it. But you can keep deferring again and again, essentially rolling your portfolio forward tax-free for decades. Here's the magic. If you hold those properties until death, your heirs inherit them with a stepped-up basis. That means all those deferred taxes vanish. Entire fortunes have been built this way, simply by using the 1031 exchange intelligently. But there's a catch. You only have 45 days to identify your replacement property and 180 days to close. Miss those deadlines and you lose the benefit. This is where investors trip up. They sell first, then scramble to find replacements, and the clock runs out. The smart move? Plan your 1031 before you even list your property. Now let's talk about a different approach. Installment sales. Instead of getting one big check when you sell, you structure the deal so the buyer pays you over time, almost like a loan. Why would you do this? Because it spreads out your gain. Instead of paying tax on the entire profit in 1 year, you only pay tax on the portion you receive each year. This can keep you in a lower tax bracket, soften the blow of capital gains, and provide a steady cash flow. Imagine selling that $600,000 property with a $400,000 gain. If you take it all at once, you could get shoved into the highest bracket. But if the buyer pays you over 10 years, your annual taxable income might be far lower, meaning a smaller percentage goes to the IRS. It's not for everyone. You need a reliable buyer and a strong contract. Next, let's move into something that's trendy and still powerful: opportunity zones. Opportunity zones were created to encourage investment in underserved communities. If you roll your capital gains into a qualified opportunity fund, you can defer the tax for several years. Even better, if you hold the investment long enough, the growth inside the fund can be tax-free. That's right, tax-free. So not only are you deferring the original gain, you're potentially creating new wealth that the IRS can't touch. Now, opportunity zones aren't a magic bullet. They come with risks. You're investing in areas that may take years to appreciate, but for long-term investors, they offer a blend of tax savings and impact that's hard to beat. Of course, the ultra-wealthy have even more tools in their toolbox. Some combine 1031 exchanges with cost segregation to juice their deductions on the new property. Others use charitable remainder trusts, selling the property into a trust, deferring the tax, and getting income for life while benefiting charity. Still, others buy property inside self-directed retirement accounts, so the gains are tax-deferred or even tax-free depending on the account. These aren't just for billionaires. With the right planning, everyday investors can use them too. But let's pause here, because none of these strategies work without one thing: paperwork. The IRS doesn't care about your intentions, they care about documentation. If you do a 1031, you need records from a qualified intermediary. If you do an installment sale, you need a properly drafted contract. If you use a trust, you need legal documents that stand up in court. Without the paperwork, even the smartest strategy can crumble in an audit. So whatever path you choose, make sure your documentation is airtight. The roadmap before 2026. Now let's put this all into a roadmap you can apply. 1. Run the numbers now. 2. Choose your strategy early. 3. Track your deadlines. 4. Get your paperwork in order. And 5. Work with experts. A good CPA and attorney don't cost you money, they save you money. The capital gains trap in 2026 isn't just a possibility, it's coming. If you're not prepared, it could cost you 6 or even 7 figures. If you found this video helpful, make sure to hit subscribe and share it with someone who's planning to sell property in the next few years. And if you want a step-by-step guide to these strategies, visit GavTax.com. See you in the next video.